Okay, let's unpack this. We're diving into the latest financials for United Spirits Limited, Diageo India, basically. These are the results for Q2 and the first half of their financial year 26, so that's ending September 30th, 2025.
Right, and it's a really interesting set of results
Mhm.
because, on the surface, the performance looks fantastic, really strong operational execution.
Yeah, the headline numbers are pretty impressive.
But then as you dig a little deeper into the notes, you start to see this other side, this long shadow cast by some really complex old legal issues still lingering.
Exactly. So that's kind of our mission today, right? To look at the great results they're posting now, but also provide the context, the ongoing risks from the
Tough
past.
balancing act.
Yeah. Let's start with that hook, the numbers that grab your attention. Consolidated net sales value, or NSV, that's sales minus taxes, up 11.6% in Q2.
Solid.
Solid, yeah. But I think the really eye-catching figure is the profit margin jump. Reported EBITDA. That's earnings before interest, tax, depreciation, and amortization.
Right.
It shot up 31.5% compared to last year. Wow. Okay, 31.5%.
Yeah. When your profit grows, nearly 3 times faster than your sales, that tells you something strategic is happening. It's not just about selling more volume.
Good point. It signals efficiency, margin improvement.
Exactly. Better pricing, better mix, cost control, something like that.
Okay, let's get a bit more granular. Looking just at the Q2 standalone numbers, so that's the main Indian booze business, basically.
Right. Scripts out subsidiaries.
Standalone net sales were 3,170 crore rupees. That's up 11.5%, pretty much in line with the consolidated growth.
Mm-hmm. And focusing on that core business, the standalone reported EBITDA was 672 crore. And that reflects that huge jump we mentioned, 32.5% growth year on year.
And profit after tax, even better.
Even better, PAT jumped nearly 41%, 40.9% to be precise, came in at 472 crore. So strong profit conversion.
Okay, now zooming back out, the full half year, consolidated, that includes everything, sports teams, the lot.
Yep. Consolidated NSV for the half year hit 6,194 crore. That's up 10.5%. Still strong double-digit growth.
But there's a little wrinkle in the half year EBITDA, isn't there? Something we need to adjust for.
Yes, exactly. This is important for understanding the real trend. The reported EBITDA for the half year was 1,304 crore.
Okay.
But USL pointed out there was a one-off hit from an indirect tax item in the first quarter, about 40 crore.
Ah, right. So if you take that noise out.
If you look at what they call the underlying EBITDA, it's actually 1,344 crore.
Got it. So the underlying growth is.
It's 10.6%, which, lines up nicely with the 10.5% sales growth. It shows the core operational profit trend is healthy and consistent once you remove that one-time item. It paints a cleaner picture.
That makes sense. And what did the CEO, Praveen Samshwar, say about all this?
Well, he acknowledged the strong performance, the good top line, and EBITDA growth. But he also sort of tempered expectations a bit, mentioned navigating regulatory headwinds, specifically in Maharashtra.
Always a factor in India, state-level regulations.
Always. And he stressed that the second half of the year is critical. With the festive season, holidays, weddings, that's the really big selling period. He called it the all-important second half.
Right. So performance is good, but the year's not won yet.
Pretty much.
Okay, that brings us nicely to the how. How did they get that big jump in profit, that 31% EBITDA growth on 11% sales growth? You hinted at it, margin and mix.
Absolutely. It boils down to their strategy. It's all about premiumization, pushing those higher value brands, the prestige and above segment, or P&A as they call it.
And that P&A segment is dominant now, isn't it?
Hugely dominant. It accounted for almost 90%. 89.6% of their standalone net sales in Q2.
Wow, so that's where all the focus is.
Completely. Right. And it's working. P&A net sales grew 12.4% in the quarter, faster than the overall average.
Which means it's becoming an even bigger slice of the pie.
Exactly. And that trend held for the half year too, up 10.9%. Yeah. Interestingly, even the popular segment, the lower price stuff they're kind of moving away from strategically, still grew 9.2% in Q2.
Okay, so growth across the board, but faster growth in the more profitable segment.
Precisely. And that shift in mix, selling more expensive stuff, directly feeds into better margins.
Right, the aha moment, the growth margin improvement.
Correct. Standalone gross margin expanded by 190 basis points.
That's 1.9 percentage points.
Yeah, nearly 2 full points. It reached 47.1% in Q2. In this industry, getting that kind of year-over-year margin lift is, well, it's pretty significant. Shows real pricing power or cost management. or both.
Or both. So what drove that? Was it just selling more fancy gin, or was there more to it?
It was kind of a perfect storm, in a good way. 4 key things they highlighted. First, they were still benefiting from price increases taken in the previous year.
Okay. Price hikes sticking.
Second, their own internal efforts, revenue growth management initiatives, is the jargon. Basically being smarter about pricing and promotions.
Right. Squeezing more value out.
Third, that mix effect we just talked about, more P&A sales. And fourth, input costs, things like glass, molasses. They were relatively stable compared to the year before.
Ah, okay. So pricing power, smart management, good mix, and a bit of help from stable commodity costs.
Pretty much sums it up.
But hang on, that last point, stable costs, that sounds a bit like luck, doesn't it? How much of that 190 basis point gain is structural from the strategy versus just, getting lucky on input prices? Could it reverse quickly?
That's the crucial question. Look, the shift to premium, the P&A focus, that's definitely structural. That gives them more pricing power long term, better brands, better margins. That's deliberate.
Okay.
But yes, they're absolutely still exposed to commodity swings. Glass prices go up, grain prices go up. It hits them. So the management discipline on pricing, that seems structural. The stable costs, that was probably a helpful tailwind in this period. They can't count on that repeating every quarter.
So need to keep an eye on those input costs going forward.
Definitely. And also, keep an eye on the regulatory landscape. You mentioned Maharashtra.
Right. It cuts both ways. They apparently got a boost from re-entering Andhra Pradesh.
Yes, that was a positive driver mentioned.
But then faced, as the CEO said, adverse policy changes in Maharashtra. It's like regulatory whack-a-mole.
It really highlights how sensitive even a huge company like this is to state-by-state decisions in India. Big impact, positive or negative.
Okay, let's shift gears a bit. Away from the core drinks business performance, there were other things going on. Acquisitions, the sports side, exceptional items.
Right, let's touch on the sports segment first, quickly. Royal Challenge Sports, PVT Ltd, RCSPL, the IPL team owner.
Yeah.
Their consolidated net sales grew 15.8% in the first half.
Yeah.
So that part of the business is also growing.
Okay. But the bigger stories in this section are probably the exceptional items, right? First, an acquisition.
Yes, a strategic one.
Yeah.
They finalized the deal to acquire 97% of Now Spirits and Beverages. That happened back in June 2025.
Now Spirits. They make craft gin, right? Like a Pusa.
Exactly, high-end craft gin. USL invested 152 crore in the first half. This is clearly about tapping into that booming premium craft segment in India. It gives them an instant credible brand in a really hot category.
Smart move, seems to fit the premiumization strategy perfectly.
Absolutely. Buying growth, buying margin, buying brand cachet.
Okay, and then the second exceptional item, much more serious, involving the sports subsidiary, RCSPL.
Yes, this was a significant disclosure. RCSPL booked an exceptional expense related to that tragic stampede incident during an IPL win celebration event back in June.
Ah, yes, I remember reading about that. Awful.
Truly awful.
Yeah.
Fatalities occurred. The company stated they provided financial assistance to the families of those who died.
And there are investigations.
Yes, the disclosure mentions ongoing judicial inquiries, a CID investigation, and a magisterial inquiry. USL confirmed they're cooperating fully.
So that's not just a financial cost. That's a major ongoing legal and reputational risk they have to manage.
Absolutely. It's a serious matter, and the costs and implications could continue beyond just this reporting period.
Right. It's quite the contrast, isn't it? They're dealing with that immediate crisis, but still pushing hard on the core business. You mentioned their advertising spend.
Yeah, it's notable. Even with these exceptional costs, they maintain their A&P, advertising and promotion, reinvestment rate at 7.6% of net sales in Q2.
So still fueling that P&A engine.
They have to. That's the growth story.
Okay, so the engine's running well, the strategy's working, they're navigating the usual regulatory bumps and dealing with this awful recent tragedy.
Right.
But there's still this other layer, the historical stuff, the baggage. Which brings us to the notes in the financial statements, the things the auditors draw specific attention to. Let's call this section the shadow of legal legacy.
Yeah, this is where things get complicated and go way back. Primarily, it circles back to issues relating to the erstwhile non-executive chairman, Dr. Vijay Mallya.
Right, still dealing with the fallout from that era.
Still, the reports mention a long-running additional inquiry. This inquiry identified deals, transactions, that pointed towards funds potentially being diverted from USL and its subsidiaries to entities linked with Mallya.
Potential diversion of funds. That sounds serious. How does this impact the current numbers, though? Is this the future financial risk, or...?
Well, according to management statements and the sources, All the amounts identified through these inquiries have already been dealt with financially. They've either been provided for meaning, set aside reserves, or expensed in past accounts.
Ah, okay. So the hit to the profit and loss account has already happened, in theory.
In theory, yes. But the issue isn't just the past financial impact. USL is actively suing to try and recover these funds. And perhaps more importantly, there's ongoing scrutiny from regulators, like the Directorate of Enforcement is mentioned.
So it consumes management time, legal fees, and just keeps that connection to the past alive.
Exactly. It's a drag, even if the direct financial hit is already booked.
Okay, what's the next big legacy issue? There's something about a loan to UBHL.
Yes, United Breweries Holdings Limited. This is another huge one.
Yeah.
USL has a massive loan receivable from UBHL on its books. We're talking 1,337 crore rupees.
1,300 crore.
And that's just the principal. They haven't even recognized the interest on that loan since March 2014. That's another 401 crore.
So potentially over 1,700 crore tied up there.
Potentially, yes. But it's caught up in UBHL's own financial troubles and liquidation proceedings. It's very complex.
And USL has done something quite bold legally regarding this, haven't they?
Extremely bold. So, separate from the loan owed by UBHL, USL actually owed money to UBHL under a trademark license agreement.
Okay.
USL decided to just offset the two. They basically said, we owe you this smaller amount for the trademarks, but you owe us this massive loan amount, so we're canceling our payable against your receivable.
Wow. Can they just do that?
Well, it's legally aggressive.
Yeah.
Especially because there was apparently an arbitral award related to the loan that went against USL. They are now challenging that award in the High Court against UDHL's official liquidator.
Yeah.
So it's a high-stakes legal fight.
Definitely one to watch. Okay, and there's one more major historical legal tangle mentioned with IDBI Bank.
Yes, another long-running dispute. This one relates to the prepayment of a term loan USL had with IDBI Bank years ago.
And why is that still relevant now?
Because it's not fully resolved. And crucially, IDBI Bank still holds a pledge over certain USL assets and also over shares held by the USL Benefit Trust.
So the bank still has collateral linked to this old dispute.
Correct. And it seems the bank recently demanded more money, an additional 46 crore related to this. USL had to deposit that money to stop the bank from potentially selling those pledged assets.
Ouch. Does USL think they'll get that 46 crore back?
They state they believe it's fully recoverable. They list it under other non-current financial assets. But the context provided is really telling.
What's the context?
The sources link IDBI's actions here, demanding more money and holding on to USL's assets, to the bank's separate efforts to recover loans they gave to Kingfisher Airlines.
Ah, the Kingfisher Airlines collapse connection again.
Exactly. So even today, USL, despite being owned by Diageo and operationally transformed, is still financially entangled in the fallout from Kingfisher Airlines via this old IDBI loan dispute.
Incredible how long these things can drag on.
Decades sometimes.
So wrapping this all up, it really feels like two different stories playing out simultaneously at USL.
Absolutely. Story one. Operationally, they're firing on all cylinders. The premiumization strategy is working brilliantly, driving that P&A growth and expanding margins significantly. That's textbook execution.
Story two.
Story two. The balance sheet and the legal department are still dealing with the ghosts of the past. These complex, high-value historical inquiries and disputes, Malia, UBHL, IDBI, they create uncertainty, consume resources, and just represent this significant overhang.
It's a fascinating contrast. A modern, efficient operation built on, or perhaps still partly trapped within, a really complex legacy structure.
Well put. They've modernized the engine, but they're still cleaning out the garage.
Okay, so that leads us to a final thought for you, the listener, to chew on after we finish. We've seen how immediate things like regulatory changes in a single state like Maharashtra can hit performance right away, a sudden headwind.
Very direct cause and effect.
But then you contrast that with these deep historical legal issues, the Malaya inquiries, the UBHL loan mess. These things stretch out for years, maybe decades. They smolder rather than flare up suddenly.
Right, a slow burn versus a sudden gust of wind.
So the question is, which type of risk do you think is actually harder for a big company like this to manage? Is it navigating those sudden, unpredictable regulatory shifts that pop up state by state? Or is it finally resolving these incredibly complex, deeply entrenched legal battles from a decade or more ago? Which challenge takes more strategic focus and poses a bigger long-term threat? Something to think about.